welcome to Money, Money, Money. Another year has passed us by and it's been an eventful one for me personally, I'm sure for you as well, and definitely for the personal finance world. So much has happened right from the start of the year when we had the entire controversy on taxation of EPF withdrawals and of course the subsequent rollback. Then we've seen a change in the manner in which small saving schemes are administered in the country. They became market linked. Then, of course, we had the fall in interest rates. And let's not forget demonetization. There's a lot that's happened. And perhaps a lot of these events will also have a bearing on 2017. That's exactly what we are here to discuss with our guests on this New Year's special episode. So let me say hello to Harshvardhan Roongta as well as Feroz Aziz, both old friends of Money, Money, Money. Gentlemen, great to have you on the show. Thanks so much for taking out the time. So I'll come to you, Feroz. Let me start off with you. First thoughts, 2016. As you look back, how has the year been?
See, I think 2016, like you just mentioned, has been a very happening year. It's been quite dramatic in terms of the changes which have happened. I think if you break that into three parts, one, from a money-making asset perspective, asset classes haven't done too much, in my opinion. Equities, golds, bonds have done reasonably well. Real estate has done bad. So all the assets haven't done too much in this year. But then coming to the news flow and the impact it would have, not just in this year, and will have a spillover effect in the years to come. I think that's been quite progressive. Overall, a mediocre year from a money-making perspective, but a very good year from a reform perspective. From a
administration and perhaps big announcements perspective. Okay, we'll talk about those asset classes. We'll talk about particularly debt because that's what the talking point is these days in just a bit. But Harsh, your opening thoughts. Has this been a wealth-generating year at all?
Well, not really, Surbhi. If you look at what happened in 2016, I think it is a strategic step taken behind for a leap to be taken ahead by the country. Now look at what happened from personal finance perspective. We talk about investing, we talk about expenditure. In all sides, individuals have been completely engrossed with money. We had a situation where you mentioned EPF would have been taxed beyond a point. I mean, it actually shook up people and people started thinking about retirement. They started feeling that all this while what they thought was tax exempt would suddenly become taxable. And so there's a large portion going to be eaten into their corpus. Then we had, of course, small saving schemes. We had a falling interest rate regime. Yeah. So all those retired individuals, all the pensioners who were dependent on the interest income have started now feeling the pinch. Now, then we look at all other elements, demonetization, of course. I mean, that has really taken, that's a big bang closure of the year.
So, Harsh, we'll come back to demonetization. I won't touch upon that right now because there's so much conversation happening around it already. Now, let's talk about the other big aspect of this year, and that's been the change in the interest rate regime. Started in 2015, and now we're down, 175 basis points, if I'm not mistaken. How is this going to impact asset classes and the way you'll manage your wealth as we step into 2017? Feroz.
See, I think interest rate is one of the variables which does not only influence debt. It actually has the power to influence other asset classes. Yeah. So point one, how will it influence debt? Whatever the money had to be made in a falling interest rate regime, using debt funds is already behind us. Okay. So moving forward, would you make too much money on interest rates falling in a bond fund? The answer is a no. Okay. And unfortunately, your monies which are there in fixed deposit, which don't get benefits of falling interest rates, only get hampered when interest falls.
Because your return is falling.
So in debt, there's no portion, either fixed deposits nor bond funds will you make you money. Point two is every time there is an interest rates coming down, there's a flight of capital from debt to equity. So equity markets get propelled. Now, unfortunately, that has not happened in the last year, and fortunately for 2017, it has not happened. A falling interest rate year, generally in the past, if you analyze the last 20 years, whenever interest rates have fallen, those years, the equity markets have given 18-20% return of this quantum if there's interest rate fall. So it's very good news for somebody who's sitting on the sidelines because interest rates have fallen and that impact has not been transformed into equity market gains. So it's still waiting to happen because there's been a lot of overwhelming news and uncertainty of unprecedented steps like demonetization. So the markets are down. So point two, which I'm making is, it's very good for equity, what has happened, but that's still not behind us and it's still stored in the market. Point Three, I think real estate should have ideally got a benefit of this fall in interest rate.
But has its other problems.
Other problems which it is grappling with.
Yeah.
So I think equity will be the asset class for 2017 because you've had a good news but not factored in. Debt had a good news, bond funds had a good news, but it's already factored in.
Okay.
Real estate has a good news, but there's enough bad news to undo it.
On equities, quick last point, since we're talking about throwback 2016, has this year been the year of the arrival of the mature retail investor? Because I've been speaking to a lot of fund managers and mutual fund CEOs, and they all say that we don't have this redemption pressure anymore. This used to be a headline of the past, 2013-14, but things seems to be changing. Feroz, your thoughts?
I think there's been a huge change and a transformation. There's a paradigm shift in the thought process of an investor today. He has been able to acknowledge that the patience is the key ingredient to make money in equity. I think that was not understood because there was a lot of myth which was in the mind, and there was a lot of cobwebs in the mind of an investor, how he uses equity to plan his retirement. Now, for example, if you look at how the mutual fund industry has benefited by this learning curve, and what is the prime cause of this learning curve is because a few years back, SEBI made a mandate that you're going to spend as a mutual fund industry close to 150 to 250 crores per year on investor education. And I think that's actually been the largest reason why this transformation has happened, in my opinion.
Okay. Harsh, you track the insurance sector so carefully and you advise a lot of clients on insurance. What do you think when it comes to maturity levels there?
Well, I would say, paradigm shift in the mindset of the, insured or the people looking to buy insurance is the acceptance of term plans. Until now, we had a situation where people did not like a fact that, you're going to pay a cost, you're going to pay a premium, and if you do not pass away, you do not get back anything. So that thought was very scary in the minds of Indians. So, however, 2016, we've actually seen that the, people are understanding the concept of insurance. People do understand that the insurance is a product wherein only you're mitigating the risk. It's risk management. And the awareness, amongst them is that, okay, fine, we can segregate our investments and insurance. We don't need to club them together.
I mean, and correct me if I'm wrong, and maybe we can debate this after the break, but it's still easier to find the right mutual fund and pick the right mutual fund. Finding the right insurance product, that's another ball game. Well, that's exactly what we're going to talk about after this break. The ideal portfolio mix, looking at the way different asset classes are expected to behave in 2017. Stay with us. Welcome back. You're with the year-end special of Money, 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 and we're coming to you from the Barking Deer in Mumbai this evening. Well, Harsh, I'm going to now start talking about products and portfolio 2017, and I'll come back to the insurance point because I really think that it's, as I said, slightly easier to find the right fund. It's next to impossible to know if you're buying the right insurance product. Let's talk about someone who is, an urban sort of retail investor, come saver, and needs to get insurance. So what sort of products can he or she expect in 2017? Are you looking at any major changes in the industry, any changes in the product offerings in this new year?
Well, not really. In fact, we would only see, from the life insurance perspective, what I think an investor should have or an individual should have in his portfolio and should restrict it to that is a good term plan. An online term insurance policy needs to have a disability and a critical illness in his portfolio. So disability insurance would mean an accident insurance, would be critical illness would be health related disabilities.
So you're saying three different insurance plans. One would be a life insurance plan, then you need a cover for critical illness as well as disability.
Absolutely. So you can also look at some combinations available that are made available, but if you can separate them and take independent standalone insurance policies, that should be the focus.
And then where does the basic Mediclaim fall in this list?
Yeah, so this is on the life insurance perspective that I said. Now from a general insurance perspective, when you talk about Mediclaim, you talk about all the kind of non-life policies. So one is medical cover is something which is going to be paramount. I mean, because we are seeing the cost of medical treatment going up year by year and there is no control over it. On a medical, make sure that you have adequate cover. There is innovation happening there. There is a lot of, the scope of coverage is widening. So you need to be very careful and make sure that you have a good medical cover. In case you currently do not have a good medical cover, there is an option to port your policy into a new one. So as and when your policy comes up for renewal, about 45 days before that, you should look at the features available otherwise in the market. And if you're not satisfied with what you have, and if you feel there's a better offering, then you should look at porting your policy into the new
product. So how does this porting a policy work, and what is the advantage of porting it out as opposed to letting one policy lapse and then applying for someone, some other product afresh?
As against buying a new one, is what you're asking.
Yeah.
So when you buy a new policy, all your waiting periods, there is a waiting, pre-existing ailments are excluded. Then there's a specific waiting period of 2 or 3 or 4 years for any specific ailments. Now, when you port your policy, you get those continuity benefits.
Okay, so no waiting periods for
So waiting periods,
specific...
the waiting period will be calculated from the day one of your previous policy.
Okay.
So you will have a continuity benefits. If there has been any exclusions in your policy, that will continue. If there are no exclusions, then you will get that same benefit in your new policy. However, if you buy a new one, okay, then all those conditions would start fresh. Okay. And you will not have a history to back up to, and get that coverage in future. So porting is definitely advisable in case you want to shift. If you do not have a policy, then of course you need to go and buy one for yourself.
I have 2 more small questions on insurance before we start talking funds. How do you rate the industry in terms of its transparency right now, in terms of its communication to policy buyers? And a quick take on, 2 separate areas that are very close to people's heart. One is retirement planning and all these retirement plans that are being sold by insurance companies. And the second is child planning and then child wealth plans, etc. How do you rate these 2 baskets and whether they are at all worth looking at, if someone doesn't have them already?
Well, I think there is a huge scope of transparency to introduce transparency in insurance field. Unfortunately, that is not the case even today. I mean, we would still see the products are still cost heavy. All the charges are not communicated effectively. Though there are regulations, there are companies and the intermediaries find a way around it. And people are invariably trapped into insurance policies.
So Feroz, same question. When you're looking at children's plans and you're looking at retirement plans, do they make sense at all to you, or would you advise staying away and looking at investments completely separately?
Yeah, if you ask me, anything beyond a term plan from an insurance company you can do without it forever. So I personally think that trying to club objectives have been hugely detrimental to one's portfolio. So with a barge pole, you should not touch any insurance plus investment objectives combined in a child plan or anything. You're better off trying to aggregate objectives.
So then, now that we've discussed protection, let's talk about creating some wealth in 2017. And here's something interesting. So for just this episode, for now, we're going to say that you're looking at an investor who's willing to take on as much risk as possible. Age is not a constraint. Other sort of liabilities are not a constraint. If you were to create a maximum wealth generating portfolio for 2017, how would you go about the asset class mix?
See, I think if somebody has to create maximum wealth, okay, so debt is certainly not going to be a portion of that. Okay, in my opinion,
at all?
Not at all.
Okay.
Because especially for 2017, if you're speaking about some periods, I know it's a little aggressive, little contrarian, but I don't see merit of having debt in the portfolio currently, if you have to maximize the return, if that's the objective, and you're keeping the objectives and goal setting, which is the conventional mindset of personal finance, aside for a minute. So if you come to that, equity 100%. If equity is 100%, if you have to take more risk, immediately what comes to people's mind is, let's play sectors. But I think that's the most inefficient way of taking risk. But taking risk in a more diversified fashion in a smaller company's fund will pay off significantly better than choosing the sector yourself. Now, there are some smaller companies fund which actually pack the portfolio with potential mid and large cap, and they've done it time and again. So I would choose 40-50% in smaller and mid cap companies, which will actually propel and will substantiate the risk taken in the portfolio.
So now this is such a teaser. I will ask you for the fund names right now itself. So do advise on some funds that you think could be good performers in 2017.
See, I think in the micro cap category, Nagnath, who's the CIO of DSP, has shown fair bit of confidence and has been able to deliver. So DSP micro cap is one of the favorite funds from a micro cap perspective, because he's picked up stocks early in the past, much before they've been known to the market. And the second one will be a Franklin Smaller Companies Fund. If you put 20% of your money in these 2 funds, which will increase the risk, of course, but will give you a commensurate return, which justifies the risk taken.
So this would be the most aggressive part of someone's mutual fund portfolio. What about the slightly more stable names? If, the aspect of bringing a bit of stability equity to your portfolio.
Yeah, again, the good news is the large cap indices have not run away too much anyway.
The market's been absolutely flat in 2016, yeah.
Absolutely. So having an anchor to your portfolio which will bring stability makes perfect sense. So I think if you had 2 large cap or 3 large cap funds, which again have had huge excess returns over and above the market, then in that category I will say Shankaran Narain, who's ICICI CIO, in his schemes has been able to do immense justice. So
which
ICICI focused blue chip fund, or the new fund which he thinks very confident about is the ICICI Top 100 fund, which he thinks is the 2017. So I had a very close conversation with him. So I would say ICICI Prudential Top 100 would be the fund of the future, and Franklin Prima Plus Fund, and Birla Frontline. These 5 funds to put together
large cap equity funds.
Yeah.
Okay, fair point. We'll take a break on that note. On the other side, the conversation continues. More products for 2017. Insurance, the kind of policies that you might want to keep in mind, and of course debt funds. Is there something still out there that perhaps can fetch you better returns than that fixed deposit? We'll come right back. Welcome back here with the year-end special on money, money, money. And of course, we're talking about themes, ideas and products that might do well in the personal finance world in the year that's coming up. So we've discussed the equity side of it, Feroz. Now I want to pin you down on debt. I take your point. You mentioned that the bulk of the gains that were to be made because of the interest rate fall, they've already been made. But nonetheless, if someone wants to invest in a debt fund and hopefully earn better returns than a fixed deposit, what fund should he or she pick?
I would say if you have to capitalize on the movement of interest rate, a dynamic bond fund would be able to do justice. Like in the last couple of weeks when RBI actually kept the rates stand still, the interest actually shot up. A dynamic bond fund will be able to capitalize on this volatility. So point one, can you use a dynamic bond fund to get better returns, a couple of % or 3% more than a fixed deposit on a post-tax basis? The answer is yes. Then if you can get tax efficiency in an arbitrage fund, which actually from a taxation standpoint works as an equity fund, but from a risk standpoint works like a debt fund. So arbitrage funds have 0 dividend tax, which on the contrary is 28-29% on a debt fund. So if you have short-term monies, 1, 2, 3, 4 months, anything greater than 1 month, an arbitrage fund will be able to give you 1% more than a liquid fund and 2% more if you are in the highest tax bracket. So IDFC Dynamic Bond Fund would be one fund. On the arbitrage fund, a Birla arbitrage fund is one of the best funds which you can look at.
Okay, some debt fund ideas there as well. And now coming back to insurance, as you mentioned, one needs the right advisor to get the right products. But on the life side, perhaps some sort of products that someone could look at, and of course on the health insurance side.
The question is that you need to look up at your cover. An individual should look into the cover. It's quite possible you've bought some insurance earlier and you think it is sufficient, but your income has gone up, your liabilities have gone up. So maybe there is a time to look at your pure insurance covers. Now what you can look at is combining certain illness, critical illness, riders along with it, because there are very good combinations available right now.
So let's get some names going as well, and we're not of course promoting any particular product, but just some policies and some insurance providers which you think are giving a good deal for the money.
See, from the life insurance perspective, I think when you buy a life cover, the financial strength of the insurance company is important. You need to look at the claim settlement ratio. So if you look at all these things, the top 5 insurance companies, could be ICICI Prudential Life Insurance, HDFC, would be Kotak, Birla or SBI. When you look at these 5 insurance companies, you more or less get everything that you want from them in your life insurance portfolio, from especially a term plan perspective.
Okay, and what about critical illness and the disability cover that you said is also a must?
So critical illness is again, you could take it from a life insurance company again. Like for instance, the ICICI iProtect Smart actually offers you critical illness as a combination. And it's a very good combination that is available with an exhaustive coverage. So that is one that you can look at. Now looking at the medical cover, you buy a base policy from, again, the companies which do not have any sublimits. There is one section of companies which actually restrict the coverage.
So again, some examples please of companies that do not have these fine print limitations.
Yeah, so you could look at Apollo Munich Easy Health is one policy, a Tata AIG Mediprime, you could look at HDFC General Insurance, you could look at Bajaj Allianz. So these are the policies which do not have these kind of restrictions.
Gentlemen, before I let you go and enjoy your New Year's Eve, one personal finance tip for 2017. Feroz, anything that comes to mind?
Yeah, sure. Personal finance tip from 2017. I think from a tip perspective, I would say compromising on liquidity which I think quite a few retail investors do, should not be done. Okay. So liquidity is the most important attribute of an investment, because a large portion of Indian wealth is in real estate, which is illiquid. Actually, academicians define wealth as that portion of your net worth which is portable, which you can take around and access on a click of a button. So I meet a lot of people who actually don't give importance to liquidity. I think that's the paramount prerequisite for an investment.
Okay, so keep those investments liquid, keep that in mind. Harsh, your tip for 2017?
Well, I think I'll refer to a proverb which says that when one door closes, the other one opens. Okay, so the problem is the investors do not look at that opportunity. So while in 2017, again, I continue to believe the interest rates are going to come down. So you have a choice either to look at interest rates coming down and keep cribbing about it, or you look at that as an opportunity in another asset class. Like we mentioned, if interest rates are going to fall, you will see growth in equities. So you have to look at that and you have to accept and embrace it. You cannot just simply sit over it and think that my deposits are not going to earn me enough. Inflation is going up. How do I manage? The government is not doing enough. Well, that is a perspective you could have as an investor, or take it as an opportunity to move your assets from possibly being dependent on fixed interest instruments to coming into floating rate bond funds, dynamic bond funds, or even look at equity as an asset class. Okay. So this is a tip. I think just let's not get too rigid. Let's not get cranky on that note of interest rates falling, markets not giving anything in 2016, and look at positively and participate in the growth of the economy.
Well, that's a fantastic note to end on, something that applies to personal finance and to life. When one door closes, another will always open. Gentlemen, thanks so much for taking out the time. Wish you a wonderful end to 2016 and a very happy new year as well. And that's the wish we carry to all our viewers. May 2017 fulfill your dreams in every possible way. We'll see you again in the new year.